Welcome back, everyone, to another episode of Fear-Free Passive Investing. Thank you so much for being here. My name is Lucas Miller, host of this show, host of the channel on YouTube, and I'm really excited that you're here. Today, we have a great show, and we're talking with Daniel Holmlund, who believes everyday working professionals are going to be able to retire in 3 to 5 years. During the day, he's an engineer for a large Silicon Valley CPU manufacturer. But during the evening, he works with investors on how to get them passive income, just like us, just like this show. So I was really excited to have him on the show. Now, Daniel is an active investor, but a passive investor as well. And today's show is going to focus on his passive investments more than his active stuff. But Daniel is also the host of the WIN Multifamily Show. It's a podcast dedicated to interviewing people in the multifamily space. So it's really exciting to have another podcaster on the show. And we're going to get into some really good stuff. But in the show, we talk about passive investing and how it can kind of snowball into passive income, significant income. And if you're interested in seeing how this works with syndications, I encourage you to go to fearfreepassive.com/roadmap, or just click the link down in the description to get a free guide on how you can get over $40,000 in passive income in less than 5 years by just doing one syndication a year, which is what Daniel did. So if that sounds good, hit the link, grab your copy. And now that we have that out of the way, let's jump in and start talking with Daniel. All right, Daniel, thanks for being here. I appreciate you coming on the show.
Thanks, Lucas. It's really a privilege to be here.
Yeah, I'm excited to dive into your passive investing journey. But for those who don't know you, give us like 30 seconds or a minute or 2 minutes, whatever, of how you got to where you're at right now and your real estate investing journey.
Sure. Well, my name is Daniel Holmlund. I am actually a full-time engineer at Intel, and I also participate in both passive and active investing in real estate. And I got my start, back in 2002, buying single-family homes. Kind of the same story that you hear from a lot of different people, right? You get started with the single-family investments, and you realize that you want to scale it up and to become more actively involved. And so I did go through the 2008 financial crisis. I had been doing hard money loans to some rehabbers, actually in the Florida area. And this was at a time that my wife and I were living overseas. We were part of a volunteer organization overseas, and I was trying to make a little bit of extra money to support us as we were over there. And one day I got a call back from my rehabber in 2008. And he said, "Hey, you know why I've been avoiding your phone calls for the last month?" I said, "No, but I'd love to know why." "Well, you're not getting your money back." And so he instead deeded me the house, which I kept as a rental property until 2015. And around 2016, I started becoming more interested in multifamily assets. And so that's really the origin of my multifamily story.
Holy smokes, that's a rough way to enter. So
well, it was informative,
I assume
though.
it worked out okay.
Yes, yeah, it did. We rented the house for a number of years, and then eventually when the market picked back up in Florida, we sold it.
Okay, so you weren't a brand new person in real estate when you decided to go into multifamily. Tell us what drew you, I guess, to passive investing as opposed to buying more rental properties like single family homes.
Yeah. So I, like a lot of people, listen to a lot of podcasts, read a lot of books, and I got the bug. I learned about multifamily investing also from Joe Fairless's podcast.
Sure.
And I kind of made a conscious decision, am I going to go and find a mentor, or am I going to go find people that I know are in this industry that have a great track record and just learn what they're doing? And I decided to take that second route. And so I looked around. I eventually found a group down in Houston, Texas that does multifamily value add syndications. And I looked at their track record for quite a while and eventually invested with them on a 56 unit down in Houston. And so I was also the type of person who would ask a lot of different questions. I wanted to understand their business model, I wanted to understand how they made their money, how their legal structures worked, how everything in their business worked. And so, I was just a person who was polite and asked a lot of questions, and eventually started forming a really good relationship with them.
Okay, so you touched on a lot there that I want to dive into, but when did you? So when you first started investing with this group, how long from when you had that initial phone conversation to when you actually pulled the trigger? How long was that?
It was probably, let me think about this. I
Roughly.
want to
I
say
mean,
it was 6 months.
okay, so a long time.
Yeah.
Nice. And how, I guess, did you, when you first started investing with them, when you pulled that trigger, did you know you eventually wanted to get into active multifamily real estate, or were you just thinking you wanted to stay passive at that time?
I had an eye towards going active. Yeah,
Okay.
I've kind of got the real estate bug in me. I really enjoy it. People in my family have done well with it, and
Okay.
I wanted to learn the business from them.
Okay, so you wanted to learn as much as you could in that roughly 6 month period, and then you just pulled the trigger. So that was great. What in that group, and you can mention them if you want, but what in that group did you see that you really liked and you wanted to hitch your wagon to them?
Sure. So the group was Three Pillars Capital out of Houston, Texas. And the thing that actually initially attracted me to them is that they had a outreach program where they were
Oh,
going to their passive investors and they were involving them a little bit more in their deals. So they
oh,
would say
interesting.
for those people that are interested in learning the business, and who want to be passive investors, what we're going to do is we're going to allow you to invest as an LP or a limited partner in the syndication. But then we're also going to give you tasks to do that will help you to learn the business and establish a track record.
Hmm,
And I
interesting.
thought that was really interesting, right? Not only were they providing an investor return, but they were also cultivating their own network.
Okay.
And so, to be honest, one of the reasons I went with them is because they provided a mechanism for me to interface with them.
Okay, interesting. So how did that work out? Did you learn a lot? Did you have a good
Yeah.
experience with them? Yeah.
Yeah. So, I mean, the first task that they had me do was a fairly simple one. They wanted me to come up with 50 ways that I could create better community at their properties. So, that was a fairly simple task. I brainstormed 50 ways, everything from, handing out coffee and a breakfast croissant in the morning to Halloween events that you can do to different types of, on-site barbecues. And so I made them a list and sent it over. That was a fairly easy task. Probably one of the more difficult tasks that they gave me, and one that took more time and research. This one took me about 3 months to do. They wanted to know the best property management groups in the Houston area, and their business was expanding quite a bit. Actually, they're around 100 million in assets right now, and they were looking for some top level property managers that could oversee one or multiple properties. And so what they had me do was create a spreadsheet of, and I live in Portland, Oregon, for your audience out there. So I wasn't local, so I had to be able to do this over the internet. And so I made a spreadsheet of the top 10 property management companies in Houston, and then came up with the top 15 or so people that were at those firms, and did a little bit of research into each of their backgrounds and came up with a strategy for attracting them,
Okay.
headhunting them. So
Gotcha.
my deliverable was to give them 150 people that they could potentially interview for a property management position, and a way to approach them that would be attractive to them. So, for
Oh,
instance, that would
okay.
be, this person has been at the same property for uh, uh, 5 years, and then they move to another property for 2 years and another property for 3 years, and each one has been successively larger. This person looks like they're trying to scale up the number of properties that they're managing, and just give them little insights like that.
Interesting. So, I mean, that's definitely not typical of a passive investor. That's like a hybrid almost, a passive active investor. And that's really unique. I've never really heard of that necessarily before that. But let's talk about underwriting. So that 56 unit deal in Houston, you obviously saw something you liked about it. How did you analyze that as someone coming in? You knew a little bit about real estate, but not, I mean, you didn't know everything you know now. How did you kind of vet that underwriting?
So they sent me the underwriting. One of the things that I actually did that was incredibly educational was to read through the entire private placement memorandum,
Yeah.
and that was actually one of the ways that I learned the most about their business and the business of syndication properties.
Oh,
I also
interesting.
got their underwriting. I got all their insurance documents. I got their FEMA documents.
Wow.
Everything to
That's a
do
lot.
with the legal structure. So they provided me with all the materials to the deal that they were currently working on. The underwriting was not too difficult to go through. There's a couple of great courses that are out there on Udemy, and I will get the name of the person, but there are some very comprehensive courses. It's like a 10-hour course on how to do underwriting, and it's on Udemy. You can purchase it for $20, and it does an excellent job of
That's
going
cool.
top to bottom through a multifamily underwriting deal, and it's very comprehensive. So there's a number of really good resources out there where you can teach yourself how to do underwriting.
Hmm. So you found out, you did your course on underwriting, you figured out what you liked out about the deal, and then you pulled the trigger. Take us through what's happened since then. Have the returns been better than you projected, or good? And how has that given you confidence to move forward to start doing your own deals too?
Yeah, so the name of this apartment complex was Sycamore Gardens, and it was in Houston, Texas, down in the Pasadena area. It's a 54 unit, and
54. Okay.
it is a Class C value add deal. So basically, the idea is that the business that takes it over brings in new capital. They fix up the units, they add new value to those units, they create a better standard of living for the people that are there, and they also ask for a greater amount of rent, which they then use to give a return to their investors. So that's the basics of a value add, syndication business plan. And that's exactly what they were doing here. So they came in, they took over, they very quickly started turning units. So uh, 11 at the 11-month mark, they had actually turned enough units that they decided to refinance.
Oh,
And
nice.
so they refinanced, and I got 23,000 of my 75K that I put into the deal back,
Wow, that's
which
pretty
wasn't too
good.
bad.
That's
It was
great.
great. I was getting a quarterly check at the time. They've switched over to now they've switched over to quarterly. I was getting a monthly at the time. They've switched over to quarterly. So the distribution is quarterly, and they've been executing fairly well. I
So
think that the last
that's
newsletter that I
30% of
received,
your return. That's pretty good.
yeah, no, I have no complaints about it.
Okay. So you're getting the quarterly cash flow. You're getting 30% of your money back in 11 months, which is great. How was investing with them? Like, you clearly enjoyed that return, but how was working with them as a sponsor? Do you regret choosing them as a sponsor? Do you like them? And you don't have to give a lot of details, but
Sure,
how
sure.
did you basically gain confidence in investing with them?
So I talked to them a lot via email,
Okay,
and
cool.
they're very savvy guys. They're the types of guys that I want to be on the same side of the negotiating table with.
Okay.
So not on the opposite side of the negotiating table. They know what they're doing, and they're looking out for their business and their investors.
Okay.
Um, and they've managed to build a pretty good network as well.
Cool.
And so that particular deal, I don't expect that there's probably going to be another refinance or sales event. Probably for another 5 years or so would be my guess, 4 to 5 years. And so the rest of that capital will be tied up in that investment until that liquidity event happens. But they're definitely they're very savvy, and they know what they're doing.
Yeah, that's good to know. Because I think a lot of fears that investors have right now, especially right now, is getting involved with the wrong person. So, moving forward, talk us through what you're seeing in your crystal ball for commercial real estate investing right now. Should people be fearful? Should people be, bountiful, or what do you think right now?
Sure. So the first thing that I would say is that you're absolutely right. You have to know the people that you're investing with. And that is rule number one. The operator is more important than the investment itself. So knowing the people that you're investing with, spending a little bit of time to email with them, to correspond with them, call them on the phone, get to know them a little bit. The more you know these people personally, the more you can make a judgment about whether they're worth investing, taking and investing your hard-earned money with. So I definitely encourage you, know the people that are working the deal.
Okay.
And that is the number one rule going forward. If you know the people that are there and you know that they have a track record that you can go and investigate, then you can have a reasonable amount of confidence that your investment will perform well. So moving forward, right now, obviously, we're in the middle of the COVID-19 pandemic, and there's a lot of FUD, fear, uncertainty, doubt, going on in the market right now.
I like that.
It's that's played itself out in a number of different ways. Sellers and buyers right now have a lot of mismatched expectations. So some of the real estate investors out there were thinking, oh, well, it is obviously terrible that there's a health crisis going on, but this might be an opportunity for prices to come down a little bit, and maybe we can find a good deal out there. And it turns out that so far that isn't what's happening. So far, there have been a number of programs for forbearance on mortgage payments. So if a seller can't make their mortgage payment, they can ask for a delay in the time that they need to pay their mortgage payments. Yeah. So far, in both April and May, collections have not been too far down. So, for instance, if you look at the National Realtors Association, they have a survey out of rent collections, and the rent collections are around from May 1st to May 6th. Rent collections are at about 80%. And at this time last year, they were at 81%. And so it's not too far down from historical norms yet. Now, moving forward, nobody knows. It could go down. The market has the potential of going down. But so far, we haven't been seeing that. And I think that one of the reasons why I started about 2 years ago converting my own portfolio from the typical Wall Street stocks and bonds portfolio to multifamily properties is because the value of a multifamily property or the value of a commercial property in general isn't based on consumer sentiment directly the way a stock or a bond is. Yep. If IBM has a great quarter, then suddenly their stock may go up 10%. If they have a dismal quarter, it'll drop through the floor. The oil stocks right now are particularly hard hit because oil is going through some international troubles. And so a lot of those stocks have dropped down tremendously. The value of the stock is based on people buying and selling it. Yeah. And that's a little bit different than commercial properties, because commercial properties are based on the income that the property generates. And so you're not going to have as wild of a swing effect as you get when your price is based on your consumer sentiment. When your price is based on your income, it's going to take a little bit more time for that to filter through, and you'll avoid a lot of the tremendous shocks up and down. Yeah. The other thing that I like about it is that if you know your business well, you can make good predictions, and it's called underwriting, as to what your income is going to be in the future. And so you can actually make, multi-year projections and say, hey, if the economy stays flat, this is what we expect. If it goes down 30%, this is what we expect. If it goes up, this is what we expect. You can make educated income projections for these properties, whereas you can't really do that with a stock. The stock is based on the consumer sentiment going up and down. And so that's one of the reasons I like multifamily properties.
Yeah, I totally agree. And I would echo the fact that multifamily is one of those things where it's the gateway drug to commercial real estate investing, almost, because it's so attainable to a lot of people. A lot of people have lived in an apartment before. A lot of people can tangibly understand that. and that's not going away anytime soon. So whether this pandemic lasts for a decade, whether it lasts for 10 more days, multifamily is still going to be there at the end of this. Whether prices go up, prices go down, rents go up, rents go down, it's still always going to be something that's in demand. And so the way you make money on that is like you were talking about, you underwrite and you make predictions on how best you can navigate that. But you're exactly right that this multifamily thing is really where I personally want to be at right now in the situation of an emergency or a pandemic or anything like this. This is a very stable asset class, and I'm totally in agreement that the brokers that actually sell these properties are acting as though nothing has really changed yet. They're still
So far.
asking the same amount of money. They're still telling you values are going to go up. Whether that's true or not, it's who knows, like you were saying. But certainly it feels like it's business as normal after that whole, late March, mid-April, early May. Now we're starting to feel like we're back to normal almost.
Mm-hmm.
And, who knows where we're going to be at, but all things considered, and if we continue to open businesses back up and people go back to work, I don't see multifamily going down. What about you?
Well, one thing that I would say is that as a passive investor, one of the things I like about multifamily is that you can project into the future what the income is going to be. And that means that, for instance, in my particular case, if I am looking to passively invest and eventually achieve financial freedom, leave my day job, spend more time with my family, I like to be invested in an asset that is stable and can be projected forward, rather than having my nest egg in something which could suddenly have the bottom drop out of it at any moment. So I love the idea that if you're looking for financial freedom, then you need to be investing in an asset that has forward-looking projections, something that gives you a runway. And so that actually is one of the reasons why I've been investing in multifamily quite a bit.
Interesting. So I want to switch gears just a little bit here and talk about your podcast, because you do have a podcast, right? Tell us about it,
Sure.
and tell us about some of the stuff you've gleaned from people that you've interviewed.
Okay. So my podcast is called the WIN Multifamily Show. And by win, what that means is being able to win your freedom of time, being able to spend more time with your family, being able to invest and know that you have a retirement that you can rely on going forward, and that you are not necessarily going to be dependent on your job, into your 60s, 70s, and 80s, or whatever it happens to be, but being able to build in through investing in real estate the ability to have a financial freedom in the future. So it's called the WIN Multifamily Show. What we do is we talk to a lot of people that are involved in different parts of the multifamily investment process. So we'll talk to commercial brokers, property managers, insurance salesmen, investors, of course, and SEC lawyers, tax attorneys, all the different players that make up the team that it takes to put together a multifamily investment. And it's been really great. Right now we're publishing twice a week, and that's my own time where not only do I get to network with these people and to learn from their expertise, but I also get the opportunity to share it with other people. So I've been enjoying it quite a bit, to be honest.
Yeah, that's cool. That's the whole reason this podcast was started, is just because I wanted to learn from other passive investors about what they were thinking. So it's a great opportunity. But along that same line, just to wrap things up here, what advice would you give to someone who is interested in passive investing, but they're fearful to take that first step and actually wire some money?
Yeah. So I think I told you that it took me about 6 months to get to the point where I wanted to actually send money to Three Pillars Capital, these people. And I would say that the most important thing you can do is to educate yourself and to become familiar with the process, because the first time you invest, it is a scary thing. You're trying something that's completely new, and you're trying it with your own hard-earned money. and you're used to putting your money into stocks and bonds and different investments on Wall Street, but what about that person that I'm talking to personally?
Yeah.
That's kind of strange, getting to know the person who's handling my investment.
Yeah.
So I think the best thing you can do is just become educated on the process, learn a little bit about multifamily properties from podcasts like this, from my podcast. And there are lots of opportunities out there as well. There's no shortage of people that are teaching on this. So find someone that you personally identify with and learn from them.
Yeah. And honestly, I think 6 months is fine. That might seem like a long time to some people, but I personally think that that's fine. If it takes you 6 months to get comfortable with something, I think that's great. You think about how long it takes you to consider yourself an expert in your chosen field of work, whether that's a 4-year degree or, whatever that is, if whatever it takes for you to get comfortable with investing your hard-earned money, do it. As long as you continue to progress and you don't, sit on the sidelines. That's my biggest thing is once you get to a point where you're educated enough, you pull the trigger and you take action. And I think that's what you did, right?
And let me make a little bit of a clarification here. 6 months was only the time from when I met the people to when I invested with them. I was listening to podcasts and being educated probably 8 months before that.
Yeah.
So it was really it was a longer time period than just 6 months to get me to the point where I felt like I was comfortable to do it. But now that I'm doing it, I realize that there are a lot of creative ways and different ways to invest than just putting your money into Wall Street.
Yeah. And a little over a year to 6 months, whatever that is. Syndication is new for a lot of people. I know a lot of people that listen to the show, this is the first time they're ever being exposed to something like passive investing. So if it takes you 6 months, a year, whatever, as long as you're continuing to progress and make progress towards your goal, and then you take action on it, I'm all for it.
Cool.
Yeah. So Daniel, just to finish up, where can people reach out to you or maybe listen to your podcast? Let us know how to get in touch with you.
Sure. So my name is Daniel Holmlund, Holmlund, and my business is Alon Capital, Aalon Capital, and my podcast is the WIN Multifamily Show.
Cool. And all of that will be at fearfreepassive.com and definitely down in the description if you're watching on YouTube. So thanks, Daniel. I appreciate you coming on and look forward to talking with you again soon.
Thank you. Thank you, Lucas.